2017, I was sitting by a pool reading a very important book by Robert Kiyosaki that changed my mindset when it came to money and expenses. Now, the average American's number one expense is housing. However, there are some of you where your number one expense is not housing and you don't even know what it is. You don't measure it, you don't manage it. It's out of sight, out of mind, and there's no action taken. I'm Jack Allwile, and if you've been liking my channel, please subscribe to the channel and let me know how I'm doing in the comments below. Now, what is that expense that we don't tend to manage or think about? And Robert Kiyosaki in the book Cashflow Quadrant laid it out perfectly, and it's taxes. Now, taxes. What's the deal with taxes? Well, many of you work a day job, a W-2 job, where you are getting taxed on your gross income. So on paper, they give you a contract. It says you're going to make, $40, $50, $100,000. The income tax, both federally and statewide, is on that gross amount for, a normal worker. So here are just the federal income tax brackets, just to give you some background and to show how it's structured. And these tax rates are only on the income from, this column to this column. So from $0 to $11,600, you're taxed at 10%. Now, when it says the 12% tax rate on the next income bracket or next tax bracket, you're not taxed at 12% for the whole amount. It's 10% on this first bucket and then 12% on the next bucket. So in the second tax bracket, if you max that out at $47,150 as of 2024, you would be taxed $5,426, your total tax. Effectively, your tax rate is 11.51%, even though, and you can notice that's below the 12%. So you're getting taxed effectively lower, but each bracket is taxed at its own rate. So with that said, so what is the difference between getting taxed on a gross basis versus a net basis, and who gets taxed on which? So on a gross basis, normal W-2 jobs in the US, these are active employees, basically, active workers, active income. And if I just put in 40,000, which is about the median income in the US as of this recording, and obviously there's more taxes. And if you even lumped in like property taxes, sales tax, all these other taxes too, you're getting more, but we're just talking about income tax right now. But if you get taxed at 20% on your gross, your taxes would be 8,000 after tax, down to 32,000, and then your living expenses go out of that amount, right? Because your taxes get withdrawn and you're paying taxes on that gross amount. So after your living expenses, you're down to 2,000, which is only 5% of what you theoretically made at 40,000, right? But if you operated more like a business, and once again, this is not tax advice. I'm not saying that every single living expense is deductible on a tax basis. This would be something for your CPA, but there are things you can deduct, and perhaps you could deduct most things. You just got to figure out the best way to structure it. But let's say your gross revenue was 40,000 and you had the same expenses you had in this first example, 30,000. You then subtract out those expenses, and the effective amount that you're getting taxed on now is only 10,000 instead of 40,000. So you're getting taxed on $30,000 less. And what does that translate into taxes? So now you're paying 20% on this 10,000 instead of 20% on the 40,000. So you're now getting taxed $2,000 per year instead of what would have happened had you gotten taxed on a gross basis on the 40, where you were paying $8,000 in taxes. So $6,000 less in taxes And after everything, you're left with 8,000 instead of 2,000. So you have 4 times as much money left over getting with this one change in how you're being taxed. And that's 20% of your theoretical instead of five. So that's that. So why is this important? And what can you do about it to lower your taxes potentially? So one thing you could do is you could start a side hustle, a side business, and maybe deduct some of the things that you're using normally as living expenses to the business. So like maybe your internet, you could use as a business expense, or maybe you use a part of a room. You can perhaps deduct some of that square footage from your house payment, or pay some rent for an office. Those are types of things you might be able to work with a CPA and lower your taxable income. And maybe you want to start to transition from just being a normal employee to maybe being like an outside contractor where companies are hiring you and they're paying you as a business, where you then get to deduct your operational expenses, and you're perhaps will save a lot of money on taxes. So this is a game changer. A lot of wealthy people run their lives through their businesses. It's not breaking the law. It's just going with what the tax code says. And some would even argue the tax code is just an incentive structure to incentivize you to operate in a certain way. And with that prior example, you are incentivized to start companies, and there's obviously risk in starting a business of some sort. So there's risk in it, but you're gonna get to save on your taxes if you do with it. So hope you enjoyed this episode, and let me know what you think. Take care.